On June 11th, a handful of people in a room priced one of the largest IPOs in history at $135 a share. The next morning, 5 million people paid a different price. That's the story of an IPO. The size was historic, but the playbook wasn't. Hey, it's Steph, and this is your Private Market Pulse. Let's dig in. The night before it traded, SpaceX and Goldman Sachs sat down with a book of investor demand and set the offering price at $135. That number came out of a negotiation, not a market. And the moment they said it, the institutions on the allocation list were locked in at $135. SpaceX had its $75 billion before one share even traded in public. Then the morning comes. Everyone who wasn't on that list, retail, the smaller funds, even the institutions that missed the cut, put in their orders. The bell rings, and the stock opens at 150. Shares closed out the first day just under 161, up 19%. The headlines are calling it price discovery, the market finding the value. But look at the gap. $15 separated the offering price available to allocated institutions and the price everyone else paid at the open. Banks earned their fee either way, and SpaceX already had its $135. So that $15 went to whoever was allocated to the night before and chose to sell into the open. Being allocated early created a pricing advantage, and who receives an allocation is decided by the bank that controls the book. So what is that allocation list really? It's usually the big institutions a bank does business with, deal after deal. Effectively, it's a pre-sale. The names on the list get in at the offering price, which the general public does not have access to, and everyone else buys at the open and at the market price. But the $15 isn't just about keeping clients happy. There's real risk involved. SpaceX traded a few dollars for a clean sale on what was reportedly the biggest IPO ever. But here's the part worth sitting with. If the pricing advantage in IPOs goes to those allocated before the bell, are there other ways to participate even if you're not an institution with ties to the banks? The secondary private market is one such avenue, where shares in private companies trade before any IPO, priced by a buyer and a seller, not by a bank's list. But this gate is different. Here, it's not about lists or favors, it's about understanding the risks of this space. The secondary market charges its own toll. Illiquidity, prices no one really agrees on, and a wait that nobody can promise will end. But it was never about who pays more. It was about who gets in early and under what terms.